Then the next ratio to compute as per the above problem, that is, first we will read out the liabilities and asset side, friends. In liability side, equity capital 200, preference capital 100, term loan 600, bank cash credit hypothecation 400, sundry creditors 100. So your balance sheet liabilities total is 1400. Quickly read the asset side too. The net fixed assets is 800, inventory is 300, receivables 150, investment in government securities 50, preliminary expenses 100. The total amount in balance sheet includes your liabilities and asset side is 1400. We'll start with it. We need to compute first debt equity ratio. Debt equity ratio, friends, the formula long term debts divided by your owner's fund. So here long term debts, so where is the long term debts? Term loan is there in the liability side, term loan 600, so we will write in the numerator 600 divided by your owner's fund. Owner's fund I have just said in the previous slide too. Owner's fund can be calculated in the number of ways depending on the which formula to apply in which problem. Like for example, if in a problem is given as capital, reserves, miscellaneous expenses, we will take that. If in a problem these three are missing or this full entire three are not given, we will take as total assets minus your total liabilities. So in this problem we will see first, that is, we can do in both ways. I will just do in both the ways. Okay, so in the denominator for own fund, total assets minus total liabilities, this is the case one we will do first, total assets minus total liabilities. Just see friends, in the asset side the assets total is 1400. In total assets I had already said you need to exclude your intangible assets. So your intangible or fictitious asset is your preliminary expense. So 1400 minus 100 we will do. We will get 1300 as your total assets minus your total liabilities. Just see friends, in the total liabilities capital is there. We will exclude that. That is 200 of equity capital and 100 of preference capital. We will exclude 300, okay, out of 1400. So 1400 minus your 300 we will get as 1100. Therefore, 1300 minus 1100 is equal to 200 as your own fund. This is as per case 1, total assets minus total liabilities. Now we will do as per case 2, which I just said, capital plus reserves minus miscellaneous or intangible assets or fictitious assets. Okay, so capital, what is your equity capital? 200 plus your preference capital 100. So total just 300 minus your miscellaneous expense, that is preliminary expense, is 100. 300 minus 100 comes as 200. So your own fund is 200. Your long term debt is 600. 600 divided by 200, you will be getting as 3:1. Okay friends, the next ratio to compute is your tangible net worth ratio. So what is one tangible net worth? It is relevant and it's an indicator to assess the real value of a company, of a specific concern or a firm based on the balance sheet given. So for it we require capital plus reserves minus your intangible assets. So what is the equity capital amount? 200, okay, plus your reserves is there? No, but your preference capital is there, right? So equity capital 200, preference capital 100, you will get as 300 minus your intangible assets or preliminary expense or fictitious assets or miscellaneous expense. So preliminary is there 100. So 300 minus 100, you will getting as 200. So your tangible net worth is 200. Next we need to do is your total outside liabilities to total tangible net worth. TOL divided by TNW we say here. So total outside liabilities to total tangible net worth. So what is it? Friends, this measures the total leverage employed by a business. I mean the firm, it means that the firm has used its net worth a lever to raise outside funds. For example, like assume that too much of leverage is there, that is not good for an organization. Why it is not good? As it may mm, it may pose a problem for the organization to repay its obligations during a specified term or during a stress period. Okay, so your total outside liabilities divided by your total net worth, that is total outside liabilities to total net worth or total tangible net worth, shall be less than 3. It should be less than 3 so that the business can have total outside liabilities of a maximum of 3 times its total net worth or total tangible net worth. If lower number is there, it means more safety is there. If conversely higher means weakness is there. Okay, so total outside liabilities to total tangible net worth is equal to total outside liabilities. Friends, what is your total outside liabilities here? Just calculate the just compute the long term liabilities and your current liabilities. So 600 is your term loan, bank cash credit 400 and sundry creditors 100. Okay, in liability side. Total outside liabilities in the numerator we will mention here. So 1100 divided by total tangible net worth. So total tangible net worth we have just calculated 200, which is equal to 5.5 is to 1. Next comes your current ratio. In current ratio, the formula, I hope all of you know what is the formula for current ratio to compute. It's current assets divided by your current liabilities. So what is the current assets, friends, here? It's inventory, that is 300, receivables 150, investment in government securities 50. These are the three current assets. We will just add it on. We will get as 500 divided by your current liabilities, which is coming as sundry creditors 100. Your bank cash credit hypothecation is 400. 500 divided by 500 you will get as 1:1.